The International Monetary Fund, IMF, is an international organization that is responsible for monitoring the global financial system in accordance with the macroeconomic policies such as the exchange rates and balance of payments of its member states. The creation of the IMF took place through a United Nations resolution presented during the 1944 UN Monetary and Financial Conference. Delegates from 44 nations across the world met during the conference held in New Hampshire, USA, for the purpose of creating and agreeing upon a uniform framework for international economic cooperation. The IMF began operation on December 27, 1945, when the first 29 nations signed and ratified the IMF Articles of Agreement in its headquarters in Washington, D.C. Currently, 186 nations are members of the IMF. These nations are highlighted in green in the map, while non-member states are highlighted in red. Taiwan was expelled from the IMF in 1980 due to the acceptance of the One China policy, while Cuba and the Democratic People's Republic of Korea withdrew from the IMF in 1964. The Western Sahara is not recognized due to lack of governance. The 186 nations are represented through the IMF Executive Board, which consists of 24 members and 5 executive directors, whom are appointed by the 5 nations with the largest quotas. The remaining 19 directors are elected by the other members. The founders of the IMF aimed to build a framework for economic cooperation that would avoid a repetition of the disastrous economic policies that had contributed to the Great Depression of the 1930s and the global conflict that followed. In a nutshell, the IMF's central aim is to provide the world with financial stability, but more specifically, provide a forum for cooperation on international monetary problems, facilitate the growth of international trade, thus promoting job creation, economic growth, and poverty reduction, promote exchange rate stability and an open system of international payments, and finally, lend countries foreign exchange when needed on a temporary basis. The structure of the organization isn't too complex. The IMF Articles of Agreement state that it is led by a managing director, who is head of the staff and chairman of the executive board. He is assisted by the first deputy managing director and 2 other deputy managing directors. The IMF's methods of operation have changed drastically over the past few decades, most especially since the 1990s, due to the need for the organization to adapt to the constantly changing requirements of its member nations. At present, after careful adaptations and reform, the IMF has decided to improve its operations in the following ways. 1. Enhancing IMF lending facilities. The IMF has upgraded its lending facilities, which has enabled it to better serve its members. It has created a new short-term liquidity facility designed to help emerging market countries with a track record of sound policies address fallout from the current financial crisis. 2. Strengthening the monitoring of global, regional, and country economies. The IMF has taken several steps to improve economic and financial surveillance, which is its framework for providing detailed and more accurate advice to member countries on macroeconomic policies. 3. Helping resolve global economic imbalances. The IMF's analysis of global economic developments contained in its World Economic Outlook provide finance ministers and central bank governors with a common framework for discussing the global economy. The IMF now also has the ability to call for multilateral consultations, which has allowed nations to discuss specific problems facing the global economy. 4. Analyzing capital market developments. The IMF has devoted more resources to the analysis of global financial markets and their linkages with macroeconomic policy. Twice a year, it publishes the Global Financial Stability Report, which has provided up-to-date analysis of developments in global financial markets. 5. Assessing financial sector vulnerabilities. The IMF believes that resilient, well-regulated financial systems are essential. The IMF and the World Bank jointly run the Financial Sector Assessment Program aimed at alerting countries to vulnerabilities and risk in their financial sectors. 6. Working to cut poverty. At present, more than 1 billion people are living in less than $1 a day, and more than 3/4 billion people are malnourished. The IMF's role in low-income countries has changed and expanded as these countries grow and mature. 7. Greater accountability and transparency. The IMF publishes almost all of its annual economic health checks for member nations, updates about its lending programs, and a wealth of other information on its website to keep its members up to date on the organization. The IMF, however, isn't without its failures. In the late 90s, Russia became the IMF's largest borrower. The IMF would lend money to Russia expecting economic reforms in return, but none came. After $20 billion in loans, Russia hadn't made a single reform, and corruption continued to loom throughout the nation. The IMF has also been criticized for its support of military dictatorships. The aid has often been misused, for example in Pakistan in 1971, when aid given to General Ziaul Haq was later determined to have been used for military purposes. In 2001, the IMF's induced budget restrictions undercut the Argentinian government's abilities to sustain national infrastructure, thus leading to an economic meltdown. Finally, perhaps the biggest failure of the IMF is that any country that borrows money is never able to sustain reform in the long run and comes back to the IMF time and time again for more money, yet without progress. The IMF is helping many emerging market countries tackle the problems brought on by the devastating global economic crisis. Its lending to low-income countries has also been stepped up to combat the impact of the global recession with a new framework for loans to the world's poorest nations, including increased resources, a doubling of borrowing limits, zero interest rates until the end of 2011, and new lending instruments that offer more flexible terms. The global economic crisis has sparked a rethinking of how the international financial system is structured. The IMF is assisting the G20 industrialized and emerging economies with recommendations to shape the system of international regulation and governance. To a large extent, global efforts thus far have been focused on the crisis at hand, but reforms are in progress with a view toward the post-crisis world.